Okay, so thanks a lot for the invitation to the organizers, to the different organizers. It's a great pleasure to be here at the ECB. And basically, this paper is with two co-authors from the Federal Reserve Board, Matt and Alex, and two Greek guys from Essex University, another Alex and Sotirios. Okay, since this is data from the Fed, of course, the typical caveat applies. So let me just give you two motivations for this paper. So the first motivation is that there has been one of the key tools from monetary policy has been quantitative easing and then nowadays quantitative tightening. For instance, in the case of the United States, here we can see that in the times of the pandemic, the balance sheet of the Fed arrived to $8 trillion, so a massive increase. And in the last one was mainly done through purchasing on government bonds, which is the blue one. If you only have a system in which there are only banks, it's very simple how it affects the financial system through financial intermediaries. So basically, the banks sell the government debt to the central bank. The central bank pays with money, and that money is digital. And that's reserves. So it's a kind of central bank digital money, which is reserves, and banks can access to that. So the balance sheet of the Fed expands massively, but the banks are just swapping one particular security, which is these open market operations like government debt, and gets another one, which is this digital money, which is reserves. Okay? And there could be some real effects out of that. But nowadays, the system is a bit more complicated. We have this paper called The Rise of the Banking, of the Shadow Banks. The first one has been a massive increase in the non-bank financial intermediaries over the last 15 years. Okay, so non-banks are becoming more and more important. The second point is that these non-banks are not isolated from the banks, but they do a lot of dealing with the banks. So therefore, there might be some implications as nowadays the QE is partly done through the non-banking sector. But the non-banks cannot get the reserves from the central bank in general. So the way you do it is they use as banks and intermediaries. Now the banks will not be a swap of just security by another security, but there will be an expansion of the balance sheet of the banks. The banks will get, so the non-banks in a sense are selling, in a sense to the central bank, but the banks are the intermediaries, so the banks will get on the asset side the reserves, which is this digital money from the central bank, and on the liability they will have these deposits from hedge funds, from private equity, from mutual funds, from pension funds, from broker dealers. And then a question is what banks do? What is the transmission channel of this policy? As you can see here, and this was not so much in QE1, QE2, QE3. This is the balance sheet. This is the balance sheet on government debt, or in particular open market operations of non-banks. So the moment in which, in the QE of the pandemics, the non-banks sells massively the government debt. And what they do, they got a lot of deposits in the banks. Okay. And this might imply some differences in the transmission of monetary policy, and it can bring a financial stability angle because now you are linking more banks versus non-banks. So this is the motivation of our paper. So the question that we ask, a simple question is, what are the implications of QE with this bank-non-bank channel? In particular, what are the real effects and the financial stability implications? We have three particular questions. The first one is now you have these banks that on the liability they are having all these non-banks as depositors. Think about demandable deposits. They have these hedge funds, these broker dealers. What happens to the banks? Do they do any risk management on the liability? Do they do risk management on the credit side? What do they do? The second is that if in case they were doing some risk management, this might have an implication for the supply of credit from the banking sector to the real sector. And the third thing is that there is a huge literature, so far is more monetary policy. The third one, there is a huge literature on banking, just to put an example of Kashyap, Raghu Rajan, and Jeremy Stein, saying the complementarity between deposits and credit lines. And if you see in the real world, in the United States and in Europe, banks massively are very important in credit lines. And now we have these deposits. Do you have still the complementarity between credit lines and deposits, or this complementarity breaks? These are the questions. We are going to go, as Camelia, we are going to go with American data. This can be done with European data, but we chose American data. And in this American data, a question which is very important is not only the credit register, but in the United States, for every bank, they have all the different type of deposits, whether the deposits are from, say, hedge funds or private equity versus rich and insured depositors versus insured depositors, okay? So that will be crucial for pin down the particular channel. There will be a rich heterogeneity across banks, differently affected, across non-banks and across firms, okay? So there will be a typical micro paper in the sense of a lot of heterogeneity. Finally, these are kind of different shocks, but in a sense, we don't want to do only a time series paper, we want to do more also the cross-section. Because there will be banks that are more affected by the channel. There will be banks, I don't want to put a bank, but there will be even GSIBs, which are more linked to non-banks, and there will be GSIBs, which are less linked to banks, et cetera, et cetera, et cetera. Okay, and so our measure will be these shares, which is how much of the deposits how much of the total deposits are coming from NBFIs, non-bank financial intermediaries, and insured deposits. Important and I will say something because I have time, there will be no pre-trends, and is balanced. Different banks with different shares are balanced on size, deposits, capital, and risk, okay? So it's not coming from, are we comparing apples and bananas? We are comparing apples and apples, okay? Let me give you a preview of the results. And then I will go on the details. So the very first thing is that once there is the QE, and you were relying before on these non-banks for different reasons, then these non-banks are going to come more to you. So you will get more reserves, and then you will get more non-banks as depositors. Okay. The second thing is that banks are doing risk management. Once they get all these flighty depositors, they're going to do risk management on the asset side, on the liability. That could be very good on financial stability because the banks are going to do risk management because they get these fragile depositors, but this might have an implication for the real economy. In particular, on the asset side, what they're going to do is they're going to change the price immediately to the unsecured deposits. So they are going to penalize the unsecured deposits because I already got all these flighty guys. I don't want more. So I will decrease the price to them, and I will increase the price to the insured deposits. And consistent with this, so this price changes, the deposit changes, rate changes, are immediate. But you need over time a change in the capital structure, moving from this uninsured towards the insured. This is the liability. Liability is very important because you link banks with non-banks. But there will be also an asset implication, and that's very important for the real economy, which is because the price change is immediately, but the quantity takes over time, the banks are also doing risk management on the asset side. And what does it mean, the risk management on the asset side? They will start cutting credit lines, especially ones that they are not drowned, which are more difficult to stop, the ones that are not drowned, the ones that they are promised. If you think about the paper of Peydró with Holstrom in the JPE 1998, are thinking like if you don't have that liquidity, if you are a bit more afraid of the liquidity, you are going to cut undrawn credit lines. The final point in this HQLA, banks that are more affected, they will receive these reserves. But the reserves at the time of the QE, think about Europe. The reserves, they were paying negative interest rates. In the United States, they were paying very little. So they will have to comply with the LCR, with the liquidity coverage ratio, but they will try to move to securities, to liquid assets, high quality liquid assets that pay a bit more, okay? So on the asset side, they're also trying to change not only the credit lines, but the liquid assets. This change towards the more affected firms, the way they are going to react, because they have less liquidity, expected liquidity, they are going to cut real investment, corporate investment. And so these points are intended consequences of monetary policy through QE. I'm going to go to the details of my, to the details of our paper. So I summarize the paper, but just I don't have the contribution to the literature here. I think we have a clear contribution to the literature. People have not done that. But there is two papers, one American paper by Viral Acharya, Rahul Rajan, Stefan, and co-authors, talking about related issues. They are not the same, but they are related issues. And here, Carlo, Rostaño, and Schumacher has another paper. We're also pointing out not so much on the banks, if I am correct, but more on the limits of the QE for lending, okay? Which I have, by the way, have a paper with Rafa Repullo on that we also in Spain, we found that sooner or later it's better a state-owned bank, because when you give at the ECB gives money to the banks, the banks might not lend to the real economy. So maybe you want to overcome the banking sector and directly lend to the real economy, okay? But this paper is more about the banking versus non-bank sector. I have 13 minutes. Let me briefly tell you the institutional details. You already know in this audience the institutional details, but let me just say a bit. So as I was motivated at the beginning, the big change with the non-banks in the data, it comes from the QE, from the pandemic QE. And then we will exploit that one, and we will exploit also quantitative tightening. Quantitative tightening is a bit more in progress. So maybe Leonardo didn't have so much on the quantitative tightening, but this also is also there. But I'm going to put more on the QE. Let me tell you this. It's a bit of shameful to say this to you, that you know so much about these things. But just let me tell you that if there was, for the people who are not aware of this, if there was an expansion without the non-banks, basically, the bank, sell the government debt to the central bank. The central bank issues money, which are this digital money, which is reserves, and basically you do a swap. So the central bank expands. Think about the Fed expand to 8 trillion. So you expand by creating the reserves, and the banks that they do a swap between one type of security and the other type of security. But with non-banks, it's different, because with non-banks, the non-banks are not selling this stuff towards the banks. They are selling this stuff through the intermediaries of the banks. Now the banks, you have an expansion of the balance sheet. The banks have a lot of reserves, a lot of liquidity. You might say, oh, wonderful. They will lend a lot, but they have these guys on the liability, which are very flighty. And so what happens with these characteristics there? The data, one thing about the data at the Fed is that not only the non-banks are very important, but for the stress test, you have a link between every bank and the non-banks. Not only you have a link with the uninsured depositors and corporate depositors, which tend to be nicer, you also have a link with, as I was saying, with the non-banks type of broker dealers, hedge funds, and things like that. Then they have a typical credit register. We are taking the 30 biggest banks, and we have other data sets, in particular rate watch, which will be important for us because you will have also deposit rates. As I said, the strategy for this paper is exploiting the QE and QT. This will affecting different banks because these different banks have a different link with the non-banks. And as I was saying in the initial slides, the table is balanced. So you can see here the table balance. They have the same deposits, whether you are a low MBFI or high MBFI, you have similar deposits, similar total size, similar capital, similar CNI loans, and similar liquidity. This difference here is the so-called standardized difference, which follows Inven-Buldris and Invens-Rubin, okay? So they are, in a sense, we're talking on apples and apples, and the only thing is that one is a pink apple and the other is another apple, in which the non-deposits, the NBFIs are different, but for the rest are identical. Okay, so let me start with the regressions. Before I tell you the regressions, is that if we separate the two groups, when there is the QE, these non-banks, they increase the deposits into the banking sector, and when there is the QT, they cut. For the banks with low NBFI exposure, it's kind of a flat line. This is over a period of time. This is, I have to use my glasses, sorry. So this is over, so this is March 2000, so 9th of March 2020. This is March 2023. So even just at the beginning of the QE, you see a mass difference. A much differences between the two groups. And you can see that there was no differences between January and the COVID period. Everything started when the Fed started the QE. So this is just days around the QE pandemic, but in a sense, we can go back to the mid-2019, and all the effects are coming at the end of March 2020, when there was the expansion of the QE. So there is a clear parallel trends. The two groups are similar in characteristics, and then we can do regressions. The regressions that we will do is kind of, you have these NBFIs, which are uninsured, and then you will have a one parameter, one dummy for every period, with the differences between banks, which are coming from the shares that they don't have about non-bank, and we can put different fixed effects and controls. And as you can see, all the effects are coming in March. We can do the same type of regression, but put in a lot of controls. Maybe you think it's a question about BICs. Maybe you think it's a question of the supplementary leverage ratio. Maybe you think it's a question of broker-dealers. Maybe you think that banks are giving credit lines to non-banks. Whatever your story, not only we can control for those stories, all these different stories, but very important now, econometrically speaking, this is an econometric point, the coefficient is identical. When the coefficient is identical and all these alternative channels are in the error when you don't control for there, it implies that the unobserved covariance between your variable, which is share, and all these big broker dealers, supplementary leverage ratio, etc., are different. We can have lots of robustness between supervised and non-supervised. I don't know how much time I have, but I can talk later about supervised versus non-supervised NBFIs and things like that. Okay, so the first result, now going to the details, is that you are these banks, there is the QE, and you receive this flow of NBFIs. What do banks do? The banks, in many banking theories, they could go and take more risk. In other banking theories, more neoclassical, they have this particular fragility, so they can cut on risk and do risk management. And they do risk management. They do risk management because this is the stuff that I showed you so far. If you have more exposure to the non-banks, NBFIs, and you have the QE, you will get all these uninsured NBFIs, which are very flighty. What you do as a bank, that you are more affected, then you will cut other uninsured depositors, including corporate debt. And then you will try to move to the insured depositors. Now, all these things are in quantities. And you might wonder, maybe it is the bank, the insured depositors and the uninsured depositors which are driving the result, but no. It is that if you are more exposed to the QE through the non-banks, you want insured depositors, so you increase the interest rate on insured depositors, and you decrease the interest rate on uninsured depositors. So you do want to do risk management. It's not a question of quantities purely, but of prices. It is, now I got these NBFIs, I got these hedge funds, I want to cut the interest rate on these guys because they are risky, and I want to increase my interest rate on insured depositors to balance my capital structure. But there is a dynamic adjustment. Prices are immediate. What do I have here? Prices are immediate. Immediately, you change the deposit pricing. But if immediately you change the deposit pricing towards favoring insured versus uninsured, the quantities move slowly. So the quantities of deposit volumes, they adjust gradually from the uninsured risky guys to the insured guys. Because you do this gradually, despite that you change the pricing immediately, then you have to adjust other parts of the balance sheet. The first part that you adjust on the balance sheet are the liquidity. This coefficient here, the T-static is amazing because this is basically, if you get more MBFIs in March, your reserves jump massively, okay? Because this is the way you are paid. And once you increase your reserve, you are going to increase the high quality liquid assets. But what do? You move from reserves after the March 2020, you move away from reserves because they pay little to other high quality liquid assets that they pay you more. And therefore, since you are cutting on the uninsured, you always keep the liquidity coverage ratio, you always keep it constant. So you get all these reserves, they pay you little, you try to substitute with other liquid assets, which are in the LCR, okay? Then you get a bit more money. Since you are cutting a bit over time on uninsured depositors, because they are risky, at the end, as I said al final in Spanish, at the end of the day, your LCR doesn't change, okay? And the final thing I want to say, and I have 3 more minutes, so I have time, is that, okay, since it takes time, and you are changing things fast, but it takes time, what you are going to do is to change the credit lines. So and this is very different from the typical QE. Now I got these guys which are a bit more risky. on the deposit. It takes time for me to get rid of these guys, despite that I change the pricing very fast. So what I'm going to do is to cut part of the liquidity risk on the asset side. I don't cut term loans. What I'm going to cut is credit lines. But the way that I cut credit lines, it is not the utilized ones, which are more difficult to cut, the utilized ones, okay, column 1 and 2. What I do is to cut the undrawn credit lines, the ones that I promise in the future that I will give you. Because now, since I am more fragile on the liability, I don't want to have these potentially liquidity withdrawals in the future, because my liquidity, it is a big work. Okay, so basically, we do this. We have a model. I still have 2 more minutes. We extend a model of the Kashyap, Jeremy Stein, and Rahul Rajan in the Journal of Finance, because that model, and this is something that if you follow the literature, one thing in the United States and in Europe is banks are massive in credit lines, and the point is that they have deposits. So there is a complementarity between deposits and credit lines. We extend the model, and by extending the model, we show that that's not true if deposits are fragile. Once you have deposits which are fragile, you don't want to compensate and to give more credit lines. Because, at the time that the credit lines might be withdrawing, the uninsured depositors might be withdrawing, and then you are in a bit trouble. So this complementarity breaks, not only in the empirics, but also in the model. The final slide, the final 2 slides, is that if you have credit lines, and if you go back to the Tirol Holstrom, not the QJE 97, but the JP 98, in that one, at the end of the day, if you cut this type of liquidity to firms, firms will react by cutting investment. And this is what we see, very robust, very robust. And these are the results of the paper. So basically, the conclusions is that the QE nowadays, in the new world, in which non-banks are so important, the QE works in part through the non-banks. And still they need the banks. So the banks will get these uninsured depositors. And once they get these uninsured depositors, they will do a risk management on the assets and liabilities. In the liabilities, they will try to move to insure. On the asset side, they will try to adjust the liquidity, but they are never changing the liquidity coverage ratio because that's by regulation. What they will adjust is the credit lines, one particular credit lines, And these credit lines, you break the complementarity between deposits and credit lines, important for banks. And the second thing is that by cutting the credit lines to firms, the corporate investment might suffer. So one point is, which echoes with part of Carlo, Rostaño, and other people, is that there might be unintended consequences of QE for effectiveness of monetary policy, in the sense not only on the liability and on financial stability, but on cutting the supply of credit lines to the real economy, with implications for corporate deposits. I adjust 10 seconds, 20 seconds out of line. Thanks a lot. It has been a pleasure.
Thank you, José-Luis. Okay, thanks a lot. Let me give the floor to Leonardo directly.
Thank you, Carlo. Thank you for having me here. I'm very excited to discuss this paper. José-Luis, impressive that you managed to present so many results in 25 minutes. So let me dive in with the motivation, which is, I think, what follows the arc that the literature has done with QE, which the way I read it is that, well, the initial papers on QE and kind of the intellectual foundation behind QE is this idea that, if we want to put it as simple as it gets, it's like the QE is swapping long-term assets with short-term assets. The government sector, as a consolidated entity, is swapping long-term debt with short-term debt. And so this is going to bring down long-term yields because it just removes some sort of term premium that the market has to absorb. And so even if we cannot affect short-term rates, we're going to put downward pressure on long-term rates. So that's all fine and good. And then the literature has moved on by saying, well, this QE has been so large, though, that there might be some distortion effect. So this Carlo, Massimo, and co-authors' papers is in this flavor. And one flavor of this literature is that part of this distortion effect happened because what QE is doing is, well, this swap between long-term assets and short-term assets entails swapping long-term assets with reserves. Now, reserves are a very special kind of asset. Only banks can hold reserves. And so because QE is large, all these securities, the banks, this swap doesn't stop at banks, it goes to non-banks. And so this is the flavor of the literature to which José-Luis and co-authors contribute today. And the core observation of this literature is well saying, well, I'm going to put it as simple as possible, but the idea, I think, is, well, this additional reserve is funded at the margin by an uninsured demand deposits. Basically, I think the idea is like there is $1 of QE. Some of it doesn't go through banks. It has to go through non-banks, let's say half of that. And then these non-banks, some of that dollar that they get of QE, they might have to hold it in terms of uninsured deposits. And so what happens is that this alpha times beta times the dollars of QE shock might create a host of potential issues. One idea is that, well, balance sheet of the banking sector has to expand on aggregate. And if balance sheet size is costly because of regulatory ratios, for instance, this might end up undoing some credit. This is Will Diamond and co-authors have a paper on this. Acharya and Rajan have this paper that says, well, it might increase fragility because only some banks, only the safe banks are hoarding these very safe assets. The unsafe banks are there's some sorting of banks, and this can increase liquidity risk overall. And José-Luis' paper, he said, well, another thing that's happening is that banks are reacting to this rise in uninsured deposits. And the way they react, it ends up being that because they want to manage a higher liquidity risk, they end up cutting credit lines. So this is what this paper is about. I really liked it. It's a new idea. The data is just impressive. And there's many links in the causal chain that have to be tested. And so that's what I really liked, is that the paper linearly goes through the links in the causal chain. It's a credible experimental design, and it's an important setting. So let me go through this kind of causal chain and then share my thoughts on that. So I guess there's two causal chains to the paper. One is, well, QE is going to affect banks' liquidity risk, at least at the individual bank level. What's the idea? Well, again, it's a demand shock to uninsured deposits. Banks are getting more uninsured deposits. That might affect the liquidity risk of the bank. So I guess one way of approaching this paper is saying, well, what would be the null hypothesis that we want to reject? The null hypothesis that we want to reject is, well, at the end of the day, this dollar of reserve is backed by, this uninsured deposit is backed by $1 of reserve. That's as liquid as it gets. It's the safest asset that you can think of. So why would liquidity risk increase? I think this kind of null hypothesis is harder to reject at the aggregate level. I mean, it is true that the banking sector is expanding, but it is expanding with a reserve, so it's unclear how do you get fragility, at least at the first stab. But however, at the bank level, I think it's kind of easier to reject. I mean, in a sense, like they're getting a shock to funding sources, and banks can react and adjust on the liability side. And this is what José-Luis shows, is they're moving away from uninsured deposits. And in particular, there's very nice evidence on quantity and prices that shows that banks are really reacting. The second part of the chain is that this bank's liquidity risk is affecting cuts to credit, translates in cuts to credit. So what's the null hypothesis here? Well, it could be that all the adjustment that we talked about, this increased liquidity risk from this higher demand shock in terms of uninsured deposits, could happen all on the liability side. But what we're seeing is actually on the asset side, there seems to be something going on. So this, I think, is harder to reject in theory, even at the micro level, because it could be that all the adjustment that banks make are on the liability side. It's unclear why it affects the asset side. And one possible theoretical underpinning of why an adjustment in liability for banks ends up affecting assets is because there are these complementarities between the way that banks finance themselves and the type of lending that banks do. And so the evidence that they bring to the table is that they find cut to credit lines and effects on connected firms. So the first comment I have on this is on the first part of the evidence, which shows that they have this very good way of going at this, which is both with prices and quantities. This is like the most Econ 101 way in which you can disentangle a demand shock and a supply shock. You look at how prices and quantities move. So what they find is that as uninsured deposits go up, so this we can see it just as a demand shock for the bank to how much people want to hold their uninsured deposits. Okay? So in a standard demand shock, what you find is that the price of that uninsured deposit goes up. And the quantity also of that uninsured deposit goes up. So what you find is that the price is going up, but the quantity is going down. So it's not only that banks are walking up the supply curve and saying, well, now because you want more of it, I'm going to make you pay more. It's just they seem that they're reacting so much that they start cutting quantity. In other words, uninsured deposits for these more exposed banks are going down. And so then the question I think that I would push you to think about is like, well, how come this demand shock, this original demand shock, exactly as you say, the MBFIs now want to hold this deposit. There is an original demand shock. How come it was so strong that it ended up in a shift in supply? So how come at the end it became a supply shock? And here it would be nice to see some composition, not only the growth in quantities, and see how much the ratios change of liabilities. I think a possible answer to this, which is fully in the vein that you guys are going towards, is that it is true that there is this demand shock on QE, but maybe there is aggregate higher liquidity risk. So these same banks that were very exposed to these MBFIs, now they really don't want to hold all of these MBFIs, even more than they didn't before. And so now they're converging to the rest of the banks. And indeed, it's so it would be nice to show figure 2, which I think makes the point of the paper so clear, also for total uninsured deposits, and see how they behave. And this kind of relates to the idea of what aggregate implication we want to give to that. Of course, the problem of this cross-sectional, not the problem, the cross-section is great because it identifies more clearly what's going on, but the problem of cross-section, the limitation of cross-section is that we really cannot tell much about aggregates because, it could be that here I'm talking, do two simple scenarios. One is the exposed banks are decreasing their uninsured deposits in total amounts, and non-exposed are increasing them. If we compare the two, we get a negative correlation, a negative beta. But it could also be that the non-banks are increasing them a little bit less, and the exposed ones are increasing them a little bit less, and the non-exposed them are increasing them a little bit more. We would get exactly the same cross-sectional beta from the regression. So the regression is really not informative about aggregates. And so that's why it's really important to think to interpret this as to ask what is this telling us about aggregate risk. And I think, again, here the idea is that because we are likely in the scenario 2, in which both banks are increasing uninsured deposits, but exposed banks are increasing them by much less, we want to think about this. This seems to be prompting some convergence between the two types of banks. And then we want to ask, okay, why is this convergence happening? The last point that I want to make, which is it's on this other very interesting part of the paper, which is how come the credit lines adjust? This might be, one possible explanation is this complementarity between deposits and credit lines. And the paper asks, well, we've seen in the aggregate, though, that uninsured deposits are going up, at least in the time series. But then Kasha, Prajan, and Stein say, well, then credit lines should go up because these two things are complementary. And so does this evidence kind of reject Kasha, Prajan, and Stein? And so here I think the way I would try and think about it is what you're really showing is that in the cross-section, those banks that are getting this primitive shock to the uninsured deposits end up having fewer uninsured deposits in the end. And then they end up having fewer credit lines. So in this sense, the cross-sectional evidence, I think, is not that dissimilar to what the standard Kasha, Prajan, and Stein would give you. In that model, deposits are exogenous. So you shock these deposits in the model, and you get either they increase or decrease. If they decrease, credit lines decrease. I think at the cross-sectional level, that's coherent. That flavor of the model is coherent with what you find. What would be nice is if you manage to extend the model and can feed some primitive shocks to it. So feed a demand shock to uninsured deposits. Can you see how that translates into a supply shock? Does that bring down credit lines as in Kasha, Prajan, and Stein, or do we need some modifications for that? I have some other smaller comments on the aggregates we can chat later because I see my timer has become red, but thank you so much. This is a new paper, new idea, great data, gave me a lot to think about, and I think everybody interested in QE should read. So thank you for having me.
So maybe I give first the floor to...
Can I reply that?
Yeah. Please.
Could I have my slides?
I think so.
Could I have my slides? Here, perfect. So first of all, thanks a lot, Leonardo. This is a wonderful discussion. Just let me go first. So there is a theoretical point. At the end, it's a theoretical point, which is you could, in a global gains model, you could show two results, but one of the results could be that if you get X of very fragile guys, and you get X, so you get 10 of very fragile guys, and 10 on reserves, the fragile guys, of course, if the fragile guys cut, is your point, they have the 10, the reserves, no problem. But the problem is these are coordination gains. Once you are in a bank, you have these hedge funds, you have all these guys who are very fragile, not only they might run, they might make other guys in the bank run. And there is a huge other guys uninsured. So the mechanical thing 10 to 10, which is your point, might not happen in a model. And then, of course, there is a question on reality. The second thing is that in this particular case, as you can see here, it is true that your point is super well taken. I mean, cross-section versus the whole aggregate. But this is, in our case, we exploit continuous. But here, without the continuous, the top versus the bottom. So there is not much action here. It's not like, and all the action is coming here. And at the end, we are seeing that these guys are reacting. And it's not clear that these guys are picking up the slides, okay? Just in the final part. On the complementarities of credit, of deposits and credit lines, again, we are, we are completely, So first of all, it might behave very different uninsured corporate deposits. Of course, people are very worried after the Silicon Valley Bank. So this is before Silicon Valley Bank. You have also uninsured deposits which are not corporate deposits by retail people, like Peter Thiel, who was there in Silicon Bank. But it might be different for the NBFIs. So the point that we're making is that if you get these particular flighty guys, and we show in one part of the paper that the unregulated NBFIs, they move money very fast out. Okay, so it's not just purely uninsured, which could be corporate deposits, rich people, is this particular NBFI, and this is the one that breaks the complementarity between deposits and credit line. We are not criticizing at all the paper by Raghu, by Jeremy, and Anil. It's just to say that in that particular model, everything is insured, and if you make it an insured, and of course here it matters who it's an insured. It's an insured rich people, it's an insured corporate deposits, or it's an insured MBFI, which is something to work more. Do the results change or no? But your comments are super welcome. Thanks a lot, and I look forward to other comments. Thank you.
Thanks. Maybe I open the floor to a few questions. Maybe Julian, then maybe let's collect 3 questions.
Thank you. Yes, Julian Schumacher from the ECB. Yeah, thanks a lot for the paper. I mean, super interesting, and of course also very interesting results for the US. I had one question, actually 2 related questions. First is, so you focus a lot on the, let's say, the liquidity, like the initial liquidity impact that goes via the liability side, and then you show the adjustments on the asset side. But still, I think the first order impact of a QE injection is a creation of reserves, like the most liquid asset you can think of. So I think like the first order impact, and also on the liquidity coverage, if you want, and now we can abstract from the regulatory meaning of the word, but really in terms of economic terms, really depends also on the relative value that the reserve has compared to the assets that the bank was holding before, right? Because if, let's say, the relative change on the asset side improves by more than the relative change on the liability side deteriorates, then the overall liquidity coverage or liquidity, let's say, endowment might actually improve from the QE injection. So I'm really curious whether the results that you show distinguishing banks on a liability side might not also, and potentially even in a different direction, be found if you distinguish them on the asset side, depending on whether or not they hold relatively liquid or relatively illiquid asset before the operation.
Yes, let me. So Carlo, it's very fast. So it's very fast. So yes, the results weaken as higher LCR you have ex ante. So they weaken. It is there in the slides. Second, you move from the reserves to higher to liquid assets, which are still in the LCR. Okay, that pay a bit more than reserves, but the LCR doesn't change. So you're still. You cannot move away from the regulation. So there is an interaction between our results and the LCR regulation, which is in the paper and is in the slides. I don't have time. I didn't have time to show that, but it is there.
Let me go. Thanks. Let me go first to Sujit.
Thanks, Sujit Kapadia from the ECB. A super interesting paper, so thanks very much. Just 2 comments, questions. So firstly, on the real economy dimension, so you show that credit lines fall, but you're also finding that the rate paid on uninsured deposits is falling, which is going to encourage those depositors to search for yield. So the non-banks we know have also expanded lending quite significantly over the same period. So do those same firms that have less access to credit lines increase their borrowing from non-bank sources? So in a general equilibrium sense, could actually, via the non-bank credit channel, can you say anything about that? That's the first. And then the second point, which may also help to, I wonder if you can also, you're lumping together hedge funds and pension funds all in this NBFI category. So if you distinguish the type of NBFI depositors, do they have a different level of flightiness? Do you see different effects
we saw
and across the different types of depositor?
We saw different effects. So the private equity and hedge funds, they left very, very fast, the banks, as compared to the a bit more regulated NBFIs. Regarding the non-banks could kill the reduction in credit lines by the banks. First, banks are massive, still important in credit lines as compared to these ones. Second, when we do the firm level analysis, there is all the credit, including banks and non-banks, and still we see a reduction in corporate investment. So if it was perfectly, you could substitute perfectly, we wouldn't see the firm level results and the corporate investment results.
So we're losing. Guido, you had a question?
I don't know if I have a question anymore after that. Okay. Yeah, I just wanted to iterate on that, like the missing intercept. Like again, I think we're all asking the same question to some extent. It's like, again, there is an overall change in the balance sheet. There is less long-term securities somewhere. There is more reserves somewhere. And then there is this deposits that help to reallocate that. But maybe like just like having a geography of where the reserves go and what the people that get reserves do, where the reduction in long-term assets goes, and what do those people do. Like all the variation you're exploiting seems to be at the deposit. All the cross-sectional variation you're exploiting is that. But I may be wrong. But.
No, not only that, I mean, it's a short presentation, so it is a short presentation. We are analyzing all the variation. Let me tell you that the government debt went up because of the QE, the fiscal policy went up. And credit lines at that particular moment, in March, especially the already committed ones, I'm talking about the future and drawn ones, it went up. So in that sense, it is a relative statement. But going back to Amico, is, and going back to Sujit, we could analyze whether if the substitution was perfect. Nothing in principle should have happened because you are substituting one with another one, and we are not finding that. But that's a particular period. And then we are expanding that not only March, April, which was a particular moment in time, but this QE lasted 2 years, and then we have the QT lasting a bit more. But it's well taken, the comment. I mean, there were other things taken.
Okay, so unfortunately we have to close here the session, but let me first again thank all the discussants and speakers.